Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. Welcome to another session of Adam Live. Hope everyone's doing great. Today's video will be discussing the potential 2 IRA provisions that could actually raise your taxes. So another way of kind of describing this video is the tax bill and the Biden promise. So before I get started, just want to preface the fact that this is not a political video. This is a video that will address specifically the 2 IRA provisions, 138312, 138314, and I'll describe them, explain them, and then talk about how they essentially contradict a Biden promise that he made during his campaign and in the beginning of his presidency as well, which is actually a major theme of the tax bill. So if you got questions, let me know. I'm going to keep this live video 30 or so minutes and kind of focus on the tax bill. So just an update. Where do we stand today? So today there was a release of a proposed billionaire tax. Also, yesterday, there was a release of an alternative minimum tax for corporations. And essentially what's going on now is the Democrats internally are figuring out a way that they can agree on a top line number for this budget reconciliation bill so they can pay for infrastructure and a number of their programs that they feel very strongly about. Now, initially, the Ways and Means passed the tax bill, which was passed on September 15th, at least the Ways and Means Committee. And the idea was it was going to have the revenue raise in it to raise $3.5 trillion to pay for all these programs. Now, obviously, what happens in DC, people start looking at the bill. It was approximately 2,400 pages, over 132,000 provisions. Yeah, I'll repeat that, 132,000 provisions. So obviously, it's taken some time for members of Congress, senators to actually comb through it, figure out what's in it and what they could live with, or what they do not want to live with. So over the last several weeks, we've had several senators, mainly Manchin and Sinema of Arizona, talk about some of the issues they have with some of these tax provisions, mainly from Senator Sinema of Arizona. Corporate tax increase, individual tax increase, she's not comfortable with. And then Manchin had some other issues as well. So what's going on now is President Biden and his team are meeting with various senators, member of Congress, figuring out other potential workarounds. If they drop the increase in corporate tax, the increase in the individual tax rate, what they could live with, where the money can come from. Because ultimately, most people feel that you're looking at a 2 to 2.5 trillion bill. Okay, so we're going to need to find money to pay for it. Probably not going to go above the 3, definitely not a 3.5, probably around $2 trillion. So I believe, at least this is what I'm hearing from our lobbyists, that sometime this week they'll agree on a top line number. It doesn't mean they're going to vote on a bill at all. It just means they're going to agree that, okay, we're good with a $2 trillion bill. This is kind of the ideas we're looking at. These are the programs we want to fund. Now the fun begins. We need to figure out what provisions we're going to keep in this bill to pay for it. So that's why you're seeing new concepts being floated, even this new proposed billionaire tax, which actually Senator Wyden has talked about. Senator Warren, Elizabeth Warren also talked about when she was campaigning for president that there would be basically a mark-to-market taxation on certain individuals. And the way this billionaire tax is supposedly going to work is if you have income of over $100 million for a certain number of years, whether it's 2 or 3 consecutive years, then you potentially will pay tax on your built-in gains on your publicly traded equities. And anything that's not publicly traded, like real estate, there would be a way to tax it, whether like an interest surcharge that would be added to your income. And then for the corporate minimum tax, there would, let's say, be a 15% minimum tax that all corporations need to pay, with the ability to take into account losses as well. So again, I'm not sure what's going to happen. Kind of new concepts, new ideas to throw into the ring at this point of the fight, but we'll see. What we're seeing is that there are negotiations. Biden is willing to listen to Manchin and Sinema and kind of get their support, appease them, and figure out a way to galvanize support amongst the Democratic Party to get a bill passed. So going back to President Biden and his campaign, his big push when he talked about tax policy was this: no one that makes less than $400,000 will pay $1 more in tax in any of his tax policies. And you can Google it. You'll see it in various speeches and publications, whether you go on YouTube or just Google around. It's basically, been a major theme of his campaign that, hey, only the super rich are going to pay taxes on based off this bill. And again, he's essentially assuming that 400,000 is rich. I'm not sure about that. Billionaire, yeah, they're rich. Someone that makes 20, 30 million bucks, rich. Someone who makes $5 million a year, rich. Someone who makes 450, married, filed jointly, 450 grand is successful. They're not rich. I have neighbors, I have friends that make more than that. 2 doctors, lawyer, doctor, real estate developer, lawyer, they make over 450. They have a nice home. They have a mortgage. They have 2 cars. They take a couple vacations a year. They don't have mansions. They don't fly private jets. They don't have a staff of servants. They're not driving Lamborghinis. They're still struggling to put their kids through school, save for college, do all the stuff you and I are doing. So for some reason, and that's something that I think Manchin and Sinema had an issue with his increase in individual and corporate tax, is the threshold super low. It's not at 6 or 8 or $1 million. It's at the 4 or 450 level. And that's just something that the Biden team feels is the number, right? If you're above that number, you're rich. If you're below that number, you're not rich. Arbitrary. I disagree with it. I live in Miami now. I used to live in New York City. Making 450, you're not rich. Not even close. Especially if you're married, filed jointly, you got a couple kids. You're not rich. You don't have a mansion in the Hamptons. You're not flying private jets. Trust me. So I think that's some of the frustration. But in any event, that's been his theme all along, that, hey, no one making less than 400,000 will pay $1 more in taxes in the tax bill. So not going to pile on President Biden, because there's 132,000 provisions in this bill, 2,400 pages. Smart man. He's a busy man. He's got to run the most powerful country in the world. He's got a lot of things on his plate. There's no way he read every single provision of this bill. So I'm here to tell you and anyone listening or watching, including the Biden team, that there are 2 provisions in this bill that will undoubtedly increase taxes for individuals that earn less than $400,000 a year. And here they are. Provisions 138312 and 138314. 138312 is a provision that was snuck in there. Honestly, no one in our industry, in the self-directed retirement industry, saw this coming. And what 138312 says is this: no IRA is allowed to invest in any investment that essentially requires you to confirm an asset value, income level, or have any type of certification, i.e. you can't be an accredited investor to do it. What is an accredited investor? Who is an accredited investor? An accredited investor is someone who earns more than $200,000 if they're single, $300,000 if they're married, filed jointly, have $1 million of net worth, excluding a primary residence, or satisfy a certain certification, i.e. an investment certification like a Series 7. So there are specific investments like Reg A's, Reg D's, private placements, hedge funds, private equity funds, venture capital funds, real estate funds, various private business investments that require you to be an accredited investor in order to invest in those investments. And that's an SEC rule based under Reg A and Reg D. There are some exceptions under the expanded crowdfunding regulations. under the Jobs Act, which President Obama signed in 2012. So there are ways to do investments that are not require you to be an accredited investor. The issue is they're kind of limited. Most of the exciting private placements out there in the marketplace are Reg A and Reg D, which essentially target accredited investor because there's less reporting, less regulation from the sponsor. So that's why they try to push themselves into a Reg A or Reg D. Now, under 138312, the Reg A and Reg D will not be open to IRA investors. Why? Because you need to be accredited. And to be accredited, you need to certify your income or asset level or educational certification, which is prohibited under 138312. So we'll take away $12 trillion, 60 million IRAs of low income, middle income, and high income. Remember, accredited investor thresholds start at 200,000, 300,000, or you could have $1 million in net worth with very little income. So when you compare it to the Biden pledge of $400,000, here you have a situation that someone who earns less than $400,000, number one, will be restricted and not be permitted to make these investments. Okay, that's not going to raise any taxes. But there's a second part to 138312. And the second part says this. If at any time you've invested in one of these investments in your IRA, and let me be clear, these were legal and are legal today in October 2021, and you did those, any one of these investments, you have 2 years to unwind it, meaning you have 2 years to sell it or 2 years to take a taxable distribution of that asset. So follow me here. Private placements, private equity, hedge funds, venture capital funds, these are illiquid investments. You can't sell them on NASDAQ and the New York Stock Exchange on public markets. So you're going to have a limited supply of buyers. Number two, the buyers are going to be aware that you have 2 years to sell them. They're not stupid. So you're going to have to deal with a potential discount on your sale price because it's a liquid. There's not as many buyers for a 4% interest in a pizzeria or a 1% interest in a growing company than there would for your Tesla or your Google stock. That's just obvious, right? Not debatable. Number two, the buyer is going to say, hey, Adam, I know you got 2 years to sell this thing. And let's say you're just past year one, you got 7, 8, 10 months left. They're going to say, hey, I'm sorry. Yeah, you may think this asset's worth $150,000, but I'm giving you 110, 105, because you got to unwind it. If not, you're going to have to pay tax. Not a 10% early distribution penalty. Thank you, Democrats. Appreciate that. But still tax. So follow me here. Again, my theme, President Biden, no one under $400,000 will pay $1 more in tax under any tax proposal. What's going to happen? Someone who is an accredited investor that, let's say, single, made $200,000 or more. Someone who's married, filed jointly, made $300 to maybe $400, or someone who has maybe $40,000 of income but has $1 million in net worth. Why? They're retired, they have zero income, but they have $1 million of assets. They have a bunch of money in their IRA. They have a second home. They just have stocks. You know, someone's 50, 60, 70 years old. You accumulate assets, especially if you're mid to upper class. Most people in that situation, not most, but a good chunk of people will have $1 million of net worth, especially with asset appreciation, right? Assets have gone up 30% year over year, maybe more in some cases, like cryptos or Tesla stock, Facebook stock, even real estate. So there are more and more people today than 3, 5, 7 years ago that have $1 million in net worth that aren't super rich, right? They may have income of 100,000, 150, but they may have $1 million in net worth. What you're going to do under 138312 is you're going to force those people to pay tax, right? Let's say you're in a situation, you have a private placement, a Reg A, Reg D, there's no market for it, can't sell it, right? Or you're getting just horrible offers. And you're like, okay, I'll have to take it in and pay tax. Guess what? You've now just contradicted President Biden's pledge. You are now someone who earns less than $400,000, and now you are going to pay more in tax than you would otherwise based off this provision. In other words, if this provision was not in this bill, you would not owe any tax on that asset. But because of 138312, you owe tax because the provision is forcing you to take a taxable distribution. Fair? I don't know. It's not my call, but it directly contradicts what President Biden said, that no one under $400,000 of income will pay $1 more in tax. 138314, second example. 138314 is just as egregious in my book. It says, private company you can't own more than 10% of personally and have your IRA invest. Current rules are 50%. So it's going from 50 to 10. Number two, you cannot be an officer of a private or publicly traded company and have your IRA invest, even if you own zip percent. On top of that, let's continue. Same theme as 138312. If you've done any of these investments, which were legal under 4975 because the threshold was 50%, if you've done any of those investments where you own now 10%, 12%, and your IRA invested, you have 2 years to unwind it. Either sell it, probably at a discount, or take it as a taxable distribution. See what's going on here? Credit investors, again, $200,000 threshold, $300,000 married jointly, $1 million of net worth. More likely than not, you're going to have a chunk of people that are going to be in this bucket that are going to not be able to sell this illiquid asset, right? A 1% interest in a pizzeria or a 0.2% interest in a manufacturing company. Go sell them, and go sell them at your price without getting killed on a discount, because every buyer in the marketplace knows you got 2 years to get rid of them. Okay, so you're going to get squeezed. Your IRA, not just you, your IRA, your hard-earned money is going to get squeezed. And if you can't sell them, guess what? You got to take a taxable distribution of that asset, irrespective of your income, irrespective of your age. So again, someone who's retired, 60, 70 years old, they got $1 million in net worth. They're successful. They're middle class, not excluding their home. So they have a couple $100,000 in savings. They have a couple $100,000 in their IRA. Maybe they have some other assets over that $1 million threshold. You're going to force them to pay tax on that taxable distribution that would not have otherwise occurred but for 138312 and 138314. So my point here, it directly contradicts what President Biden said during his campaign and what he's continued to say. Now, again, I'm not piling on President Biden. I know if he was aware of these provisions, he would not be in favor of them. Clearly, they go against everything he stands for and I think what he believes. So if you're listening, you're watching out there, and you have an in to the president or his team, let them know that 138312 and 138314 contradicts his promise and his pledge. And I know he's a man of integrity. He's given his life to this country in Senate, spent many years serving this country. And I think he is a man of integrity and would not want to breach a pledge or promise that he's made to the American people. So that's kind of the theme of today's YouTube Live. Just something that kind of bothered me. Obviously, I'm not objective. I don't like these provisions. I think they hurt investment choices. I think they hurt the ability of small businesses, growing businesses in America to tap into the $12 trillion of retirement money out there, the 60 million of IRAs that are potentially willing to invest in these types of businesses. So on those two fronts, I think it's dramatically negative. But on top of that, it directly contradicts what the president said, that no one that earns less than $400,000 would or could pay $1 more in taxes. And that would not be the case if 138312 and 138314 are passed. Will they be passed? I don't know, right? I, along with the entire self-directed retirement industry, obviously we are super focused on educating members of Congress, senators on the negative impact, the broad negative impact these provisions could have, not just on our industry, which employs tens of thousands of people, but the impact on you, on investors, right? To have diversification, to have the ability to invest in real estate, have the ability to invest in the next great American business, whether it's Facebook or Google or Tesla or whatever it is. These businesses all start small, and they all start, at least initially, raising money through private placements, Reg A's and Reg D's. They don't just go public. If you look at Facebook or any large company, even Google, it takes years and years and years of growth to then be at the stage where you're willing to go public. So how do they raise money? They generally do it through private placements, the Reg A's and Reg D's. And a percentage of that growth and a percentage of the raise in the Reg A's and Reg D's come from IRAs. Why? There's a boatload of money in IRAs, $12 trillion. In fact, most low to income to middle income Americans, their largest source of savings is through an IRA. So why would we want to limit their investment choices? Doesn't seem like it makes a lot of sense. It's counterproductive. It runs against the Jobs Act, which was a bipartisan act signed again by President Obama. There was a lot of Republican support for it. And what was part of the Jobs Act was there's a crowdfunding provision that expanded the ability for Americans like you and me to use their retirement money, use their individual assets to invest in growing businesses. And if you take these provisions, 138312, 138314, and you stick it into a final bill, you will essentially eviscerate the value of the Jobs Act. You will stop people from having investment options and choices in their retirement account, specifically IRAs, which is the largest chunk of retirement savings. And you're going to hurt the ability of American small businesses to raise money. So obviously super negative. But again, the point of today's YouTube live was to bring light, shed light on 138312 and 138314, which again just directly contradicts everything. Well, at least President Biden's promise and pledge during his campaign that no one that earns less than $400,000 will pay a dollar more in tax in any of his tax policies, and that just would not be the case if 138312 and 138314 became law. So again, there must be something going on with my chat window here with questions, because I see that there's some disconnection there. So I'm sorry about that. But if you have questions, you can hit me up. You can email them to me at info@IRA Financial. Just type in the subject, Ask Adam. They will find their way to me. Or you can hit us up on social media, Facebook, Instagram, Twitter, YouTube, obviously. Subscribe to this channel. I do YouTube lives every Wednesday. It's also obviously taped, so you can watch them anytime if you have better things to do on a Wednesday at noon Eastern Standard Time. We also drop 3 videos a week, 3 to 4, depending on what's going on. And I do 3 podcasts as well. Adam Talks, which drops every Wednesday. Actually, the Adam Talks I dropped today is on the same topic. So if you want to listen and get a additional take on it and more details, then check out Adam Talks. You can check it and find it anywhere you listen to podcasts, whether it's Spotify, Apple, SoundCloud. And also I do Ad Mail and Ad Bits, 2 other weekly podcasts that drop Tuesday and Wednesday, where Ad Bits talks about and focuses on a bit of knowledge on a specific retirement tax or investment topic. And then Ad Mail deals with the best 3 questions from clients, also social media, sometimes non-clients, of the week that focuses on generally self-directed retirement topics. So some good stuff there. I enjoy doing them. I put a lot of work and effort into them. Trust me, I don't just show up to a video or a podcast or YouTube live cold. I research, I talk to people, kind of feel like I'm a poor man's reporter, because I dig around and I try to get as much updated information as I can to all of you, because I know you're taking time out of your busy day to watch or listen to me, and I do appreciate that. So I want to be able to give you the best, most robust, and most accurate content I can. So I think that's going to be it for today. If you do have an issue with any of these provisions in the bill, specifically 138312 and 138314, please let me know. Again, you can email me at info@IRA Financial. I will send you talking points. Call your member of Congress, your senator. I spoke to someone yesterday and said, honestly, Adam, is it going to matter? I'm one person. It does. Every voice matters. Before this process started, I would have agreed with you. And I would have said, the person answering the phone couldn't care less. They're just going to take your name down, your number, listen, pretend they're listening. Maybe they're on their phone surfing Twitter. They're not listening. But it's not true. They actually care. And it's not intimidating at all. You just basically pick up the phone, call. I think calling is easier than email, and I think it's more powerful. Maybe not easier, but definitely more powerful. And they'll listen to you. And especially if you're a constituent, they will give you the time. And those messages do go to your member of Congress. I am friendly with a number of congressmen, become more friendly over the last 4 to 6 weeks since the Ways and Means tax bill was passed through the Ways and Means Committee. And they always tell me, Adam, we get daily messages and we listen and we get our chief of staff or the right person in our team to follow up with the constituent. So we are here to listen. That's our job. That's just something that, is important as a member of Congress. They take your thoughts and your opinion seriously. So don't be intimidated. It's super easy. And definitely, you should do it. Okay. I'm getting some questions. My producer sending me some questions. We had some issue with some of these questions. Okay. I got them. So here they are. Assuming 138312 goes through, when you say take a taxable distribution, does this mean have the investment sponsor assign the asset to a vested in one's personal name? Yeah, basically. So if you're at the 2-year mark, you can't sell your private placement, your real estate venture because you're getting killed on a deal. There's no good pricing out there. Everyone's squeezing you because they know you got a 2-year window. Yeah, they're going to you're going to basically do an in-kind distribution of that asset. No 10% early distribution penalty if you're under 59.5, but you will pay tax even if you have income under 400K. So yeah, your custodian will work with you to retitle that asset. That's not the problem. The problem is you're going to owe tax on that asset, even if you earn less than 400K in income. But for this provision, you would not have been obligated to do so under the current IRA rules. Under 138314, you stated one who has an IRA LLC can get around this by changing the manager to a spouse or some other person. It's not clear to me how a manager can be considered an officer. A manager would be considered an officer because the way the provision is drafted under 138314, it talks about an officer or like kind responsibility. So they're making it broad to basically be a manager. So, our industry's talked about this, and there's going to be workarounds where you will build in language in the operating agreement that no decision can be made without the consent of this person. So whether it's a spouse or a third party. So even though it's your IRA and you'll kind of have some control, but ultimately the language in the operating agreement will give you no managerial or officer type responsibilities because you'll have to get consent to make investments or consent to do certain things, which will hopefully push you out of the definition of an officer. Another one, so why not write to the office of the president rather than just our reps? Go for it. If you can do it, go for it. You certainly can write to the president. Again, the issue is the president will ultimately sign this bill, but once it gets to the president's desk, it's too late. It's done. You're not going to be able to get these provisions out. We need to get these provisions out before the president signs it, right? Because all the negotiation is happening today in the House or in the Senate, and will happen there for the next month or so. It's not going to happen when the president signs the bill. That's too late. The president's just going to put his John Hancock on that bill and it's finished. So we need to address these questions before it gets to President Biden. So that's basically the issue, right? So that's why we're working with the House. The House is where everything gets done. Believe it or not, you think the president has all the power? Members of the Congress have all the power. Senate, some, but Congress makes law, right? Generally, the Senate will comment on it, and ultimately vote on it. But the Congress makes the law. They're the one that draft the law in most cases. So they have all the power. So we want to work with the members of Congress. We also want to work with the senators, especially in today's environment where you have such a very, very, very narrow majority by the Democrats, essentially a tiebreaker by the vice president, one or two, even one Democrat that kind of stands up and has an issue with some of these provisions, including 138312, 138314, could have an enormous impact on getting these provisions removed. I had another question come in. Is there a chance all the retirement provisions do not make it in, including the cap, that $10 million cap, which I didn't mention today? Yeah, there's a chance. Obviously, that's something we would rather, that none of these provisions enter into a tax bill. We would rather these discussions happen in the normal course of how legislation gets passed, especially from a tax standpoint. Generally, there's proposed legislation, and then there's a public period of comment. And then we can comment as an industry and then hopefully work with the drafters of these provisions to make sure that the language that gets approved is as tight as possible and does what it's intended to do. So we're okay to have discussions with, Chairman Neal and his tax writers. That's something we're welcome. We have good relationship with them in our industry. We're all about discussions and negotiation. We want to hear what they're coming from. We want them to hear where we're coming from and hopefully agree on something that makes sense for all parties. We're totally in favor of that. Do we love the cap? No. Will we concede it? Yeah, because again, we don't have many clients that have over $10 million in their IRA. In fact, there's less than 500 Americans that have more than 25 million, less than 30,000 Americans have more than 5 million, right? So we're not talking about a big chunk of people. Most of those people are over the age of 59 and a half. We do have some issues about forcing people to pay tax on IRAs, especially Roth IRAs over the 10 million mark, especially if they're under 59 and a half. Whether that's a constitutional claim or not, because again, the Roth IRA's rule said, hey, if you keep the Roth IRA open 5 years and wait for 59 and a half, you can pull the money out tax-free. And that was based off the origination of the Roth IRA back into 1997, 1998. So changing the rules mid-game just doesn't seem fair. If you want to grandfather the past Roth owners in, okay, that seems more reasonable. But that doesn't get them Peter Thiel. And Mr. Peter Thiel, which someone made the point, he's like the boogeyman of these provisions. He's the guy, right? He's the bad apple, the guy they're trying to nail. And if they grandfathered in him, there would be no revenue raise, right? They expect to raise approximately $1.7 billion under 138312, and most of that's coming from Mr. Peter Thiel, right? Assuming he has $5 billion in a Roth IRA, he's under 59 and a half. If they tax 4.9 billion of it plus at 40% tax, that's 1.6 billion. There's your number, right? So they can't grandfather them in because there's the revenue raise. So it's also a political attack on Peter Thiel. So that's what we're dealing with here, right? If Peter Thiel was over the age of 59 and a half, I don't know if this provision makes it in. Probably doesn't. It raises no revenue, and they can't go after Thiel. There's not that many Peter Thiels. Again, less than 500 Americans have over 25 million. And that number will grow. Not because rich people are sneaky and conniving, but because there's something called time value of money, compounding returns deferral. Every 8 years, your money doubles if you generate 8% rate of return in a retirement account. Why? There's no tax on that money. So we've definitely, no matter what, if you've been in a coma and just had your money in like the S&P 500, you've done way better than 8% over the last 8 years. So your money's doubled. And that's just doing regular publicly traded securities. So in 8 years, Senator Wyden will come back and say, oh my God, look at all these rich people. How many more rich people have IRAs over 5 million? Guess what? If the people that have 2.5 million IRA today, in 8 years, will have approximately 5 million. It's just the way compounded returns work. That's just why Albert Einstein said it's the eighth wonder of the world. So it doesn't mean that rich people are conniving and cheating and using private placements to do all kinds of improper things. It just means the retirement system works because it's based off mathematical formulas of time value of money. So just the frustrating point of all this. The people I've spoken to in this area that have over 10 million, majority are in their 70s, right? The majority have like 12 or 13 million. They don't love these provisions, but they said, listen, I don't care. I'm over 59 and a half. I'll take the money out, whatever. It's stupid. They would have got the money anyways. I'm not sure why they're doing this. They're more focused on the accredited investor investments because they're just more interested in diversification. I have a couple clients that have over 10 million under the age of 59 and a half, and obviously they're super pissed, right? They have a Roth IRA. They've done everything right. They've invested in publicly traded stuff, real estate, nothing super crazy, nothing exotic at all, and they're being punished. Unfair, right? And when I say a couple, I mean a couple. I have over 30,000 clients. So if I got a couple of clients, like under 5 clients with over 10 million, do the math, right? That's kind of in line with our industry. That's why it's hard to sit here and defend the cap. I disagree with it because I don't believe in capping people's wealth. Are we next? Are we going to cap Google's profit? Are we going to cap Amazon's revenue? Are we going to cap how many cars I can have or how big my house can be? I just don't think it's a good policy. Again, these retirement accounts will ultimately be subject to tax, estate tax. Even Roth IRAs will be subject to estate tax. So the money will be there. It's just not going to happen for the next 10 years, which is what they need to pay for this bill. So there you go. I hope I gave you a non-political take. Again, this is nothing against President Biden. I have utmost respect for him and his team. I just think they should look at these two provisions because they're probably not aware of them, and they do contradict his promise and pledge that no one under $400,000 of income would pay $1 more in tax, and these provisions, would prove otherwise. So there you go. I appreciate everyone watching. Thanks for spending some time with me today, and I look forward to seeing everyone again next week.